Starting in 2026, there is a new gambling tax trap that every casino player, sports bettor, and video poker player needs to understand. This is not about whether you would fund or whether the casino win-loss statement says you were up or down. This is about how the tax return reports gambling winnings, how losses are deducted, and why a person can break even in real life but still show taxable income on paper. In this video, I will walk through the rule, examples, record keeping, and the Medicare premium issue many retirees miss. Here's the hook. A taxpayer says, I broke even. So why do I owe tax? The reason is that the tax return often sees the wins first and the losses later. Gross winnings go into income. For a recreational gambler, losses are generally claimed as an itemized deduction, not as a direct reduction of the winnings on the income line. Once you understand that order, the rest of the problem starts to make sense. Before 2026, many taxpayers had a simple mental model. If I won 100,000 and lost 100,000, I broke even. If I had records and itemized deductions, the gambling losses could generally offset the gambling winnings up to the amount of the winnings. That did not mean the reporting was simple, but the outcome many people expected was zero net taxable gambling income when documented losses equaled winnings. Starting in 2026, the rule changes because only 90% of wagering losses may be deductible. The losses are still limited by gambling gains. But there is now a haircut. That means a person can have the same wins and losses in real life, but the tax result may be different. Plain English, the tax return may show gambling income that the person never actually kept. Let's use easy numbers. You have $100,000 of gambling winnings and $100,000 of gambling losses. In real life, you broke even. But if only 90% of the losses are deductible, the allowed loss deduction is $90,000. That leaves $10,000 of taxable gambling income. This is the phantom income problem. You did not keep $10,000, but the tax return may still show $10,000. Here is an example that surprises people even more. You win $100,000 and lose $110,000. In real life, you are down $10,000. But 90% of $110,000 is $99,000. If the allowed deduction is $99,000, you may still have $1,000 of taxable gambling income. The point is not that every losing year creates tax. The point is that the math is no longer as simple as winnings minus losses. A W-2G is not a report of your annual profit. It is an information report for a specific payout or category of payout. The IRS receives it. The casino reports it. The IRS matching system expects those winnings to be reported. That is why the taxpayer who says, but I gave it all back, still needs records and a proper return presentation. You cannot simply ignore W-2Gs because your year-end casino statement looks bad. For recreational gamblers, the standard deduction can create another trap. Winnings are taxable income. Losses are not simply subtracted from the winnings on the front of the return. They are generally claimed as an itemized deduction on Schedule A, subject to the gambling loss limitation. So if a taxpayer does not itemize, the losses may not provide any federal benefit. Two people can have the same casino year and very different tax outcomes based on the rest of their deductions. This is the part Medicare recipients really need to understand. For a recreational gambler, the gross winnings increase adjusted gross income. The losses are usually an itemized deduction below AGI. Medicare IRMAA uses modified adjusted gross income, which Social Security defines as adjusted gross income plus tax-exempt interest. So even if losses help reduce taxable income later, they generally do not erase the gross gambling winnings from AGI. That can create ripple effects, including higher Medicare premiums. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge. Social Security generally looks at your tax return from 2 years earlier. If your modified adjusted gross income is over the threshold, your Part B premium can increase, and your Part D drug premium can also get a surcharge. For 2026, the standard Part B premium is $202.90 per month. The first married filing joint threshold begins above $218,000 of Magi. Here is a simple Medicare example. A married couple has $210,000 of Magi before gambling. That is below the 2026 married filing joint IRMAA threshold. Then they have $30,000 of gross gambling winnings. Their IRMAA Magi becomes $240,000. That crosses the first IRMAA bracket. Using the 2026 table, Part B goes from $202.90 each to $284.10 each. Part D adds $14.50 each. For a couple, that is about $191 more per month, or roughly $2,297 for the year. Here is the bigger problem. Suppose a married couple already has $225,000 of Magi before gambling. Then the taxpayer has $200,000 of W-2G winnings. Even if gambling losses later help as itemized deductions, the gross winnings can push AGI and Medicare Magi way up. In this example, Magi becomes $425,000. Using the 2026 table, that can put the couple in a bracket where Part B is $649.20 each, plus a Part D surcharge of $83.30 each. Compared with the base Part B premium and no Part D surcharge, the household increase is about $12,700 for the year. Some people hear this and immediately ask if they should be treated as professional gamblers. Be careful. A professional gambling position is fact-specific. It generally requires business-like activity, regularity, a profit motive, and strong support. It is not something you become simply by calling yourself a professional. Most casino players and sports bettors are recreational gamblers. And that is where the Schedule A and AGI problems become so important. The best defense is documentation. Keep a gambling log. Track the date, the location, the game or betting type, the money in, the money out, and the net result. Save W-2Gs, jackpot slips, bank records, receipts, sports betting statements, and casino win-loss statements. A casino win-loss statement can be useful, but it should not be your only record. The goal is to be able to reconstruct the year if the IRS asks how you calculated the winnings and losses. The action plan is simple. First, track the gambling activity monthly. Second, run a tax projection before the year ends, especially if W-2Gs are piling up. Third, save for tax, because withholding on gambling payouts may not cover the real federal, state, and Medicare premium consequences. Fourth, get advice early. Waiting until March or April can leave very few options. Good planning happens while there is still time to change behavior, increase withholding, or estimate payments. Here are 3 mistakes to avoid. Number 1, netting gambling wins and losses in your head and failing to report the gross winnings. Number 2, relying only on the casino win-loss statement without your own records. Number 3, ignoring adjusted gross income, Medicare IRMAA, and state tax consequences. These problems are not hard to avoid, but they require planning before filing season, not after the year is over. Here's the final takeaway. Starting in 2026, gambling tax is not just about whether you won or lost at the casino, the sportsbook, or the video poker machine. It is about how the law treats the winnings, the losses, the records, the timing, and the impact on AGI and Medicare premiums. Keep records, run projections, and get advice early. Before we wrap up, if this video helped you, please like it, subscribe to the channel, and share it with someone who gambles, especially someone on Medicare. And I would like to hear your opinion. How do you feel about this new law? Do you think it is fair, or is it a tax trap for gamblers who break even or lose money? Leave your thoughts in the comments below.